the angle of attack has changed. The Fed has said this is not going to be some triangle sawtooth. It's not going to go up sharply and then come back down sharply, which is what we would all want if we wanted things to get back to normal sooner. The angle of attack is now a little bit slower, which means it's going to take longer to get where we need to be, and then we're going to stay there for a lot longer than we want. And when you roll those two things together, a lot of companies may run out of money. And so if you can't get to default alive, you have to look at your cost structure and figure out how to right-size this thing, because the cost of capital is just going to be really, really expensive. Powell said he'd rather overcorrect and break things because he has a toolbox to fix the broken bones, but he doesn't have a toolbox to fix if they undercorrect and they have rampant inflation. I mean, not more explicit you can't get, Jason. So he's going to take rates until demand is destroyed, and enough demand is destroyed such that inflation is tamed. But that has huge implications to all of us, because we all have to do our job trying to build a company, trying to raise money, trying to invest money. It's just getting much, much, much harder than I even thought. So for me, I'm like, wow, I thought that we could get through the worst of this by mid-23, but now you have to plan for the worst, which means, okay, now I'm thinking that, man, rates could be higher for much longer, which means, we could be in this market till early 25. And you may say, hey, that's way too conservative. Yeah, but you have to plan for conservatism in this point. So how do I invest money right now? Honestly, I'm like, I should just put it more into T-bills. Isn't that crazy? If a company's like, hey, Chamath, can I have another 10, 15, 20 million bucks? I'm like, wow. I mean, I don't think that gets you anywhere. And oh, by the way, that 10 or 20 million dollars, I can generate 4%. What a tough trade-off, right? I just don't see anybody rewarding hypergrowth that is burning a ton of cash, where you have to be back in market every year, because it's just very hard to feel comfortable that the conditions on the field aren't going to be drastically different a year from now, right? It's not like we know that it's going to be better or worse. And I think that uncertainty is actually really bad for companies. So to your point, it's just like a lot of folks have tried to shy away, David, from actually revisiting their valuations. They've done these complicated converts, and they've tried to basically, I think it's sort of like managing their ego, or the board's ego. And I think the next shoe to drop has to be these founders and these boards just saying, okay, let's just take the hard medicine. What's the real, market clearing price and valuation? Let's get a third party to price it, and let's get new fresh equity and then move forward. Because if you don't do that and you wait until everybody's trying to do it, then it's going to be a really tough scenario. So better, to your point, this is why Stripe, it's so smart. Better to cut now. Again, it's always hard to let people go, but it's better to do that now than 18 months from now, because you just have no idea how much more expensive or hard it's going to be then. And who's going to even be in the business of lending money or investing money in 18 months? And that sounds pretty crazy, but it's like, I think that's the moment that we're in. This is just math. It's not a judgment on any of these companies. It's just pure math. This is why I think you have to be utterly unemotional in this moment. And if you're a CEO running a company, particularly a SaaS business, you have to really figure out how to right size your cost basis. If you take a very balanced view of what happened this week, you have to start, I think, with the Federal Reserve. And really what they said is rates will probably be higher than all of you think, and they'll be higher for longer than all of you want. And again, without debating whether, that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it. And basically what it means is that the dollar that's right in front of you is now meaningfully more important than the dollar that's far, far away from you. So let's just assume that the Fed funds rate goes to 5.5% or so, even 5. Let's go to the optimists and say it's only going to go to 5. Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits. And that's going to affect how companies get money, the cost of capital, so how much dilution you have to take. So I think this is what companies are now bearing down for. They're realizing, oh man, I need to get my cost structure way in line. It is way better now, just to think about this contrast. It's way better to grow at 20% and be profitable than it is to grow at 100% and burn money, because it's not clear where that second company is going to get the incremental dollars they need for growth. And that's just a mathematical realization when rates are 5%, risk-free rates are 5%.
Yeah,
so,
I think this is that moment where you see that pivot from growth to profit.
Yeah.
And, we've been talking about it for 6 months, but this is how it is manifest in Silicon Valley companies of scale is through layoffs and cost reductions and cost savings. So the investments in future growth are reduced, and the timeline to drive greater profits is improved. I think if what Elon is going to do at Twitter, or what is reported, so this is nothing to do with anything anyone told me, just what I've read in the reporting, is accurate, that he's going to cut so deep, he's going to cut 30, 40, 50% potentially of the employee base. It really sets a new standard for how profitable a tech company can get. And again, I'll give credit to a Twitter poster named Postmarket, who I didn't give credit to a few weeks ago when I read this tweet, which I think was a good one, which was that Elon's really going to show everyone just how profitable these tech companies can be, just how lean they can be run. And when you're doing a 10% riff or a 13% riff, you may or may not even be getting to profitability with that riff. When you cut 30, 40, 50% deep, and you can actually turn a real profit on a business, an enterprise scale business, like a Twitter or like many other enterprise software companies that are out there right now, it really kind of sets a new standard that a lot of folks might then end up saying, you know what, maybe we should go deeper. And there could be the case that private equity firms take a look at this. And there's a lot of these distressed mid-cap and small-cap software companies out there that private equity firms now realize, wow, you don't actually need 50% of the workforce in order to keep the product running and to drive to profitability. And you could see a bit of a flurry of buyout activity as more folks come in and maybe try and mimic the Elon playbook. So, that's one kind of prediction I think may arise. If Elon is successful in making Twitter a much more profitable enterprise, it could set a new model that catalyzes a lot of other M&A activity, a lot of other buyout activity of these distressed small and mid-cap companies by other actors.
It essentially shows the private software universe and then the public software universe at different levels of valuation. So as an example, right now, there are 15 companies, private companies, that are valued greater than $10 billion. And there are 40 public ones that are valued greater than 10 billion. There are 50 companies between, more than 5 billion, but only 60 that are public that are valued more than 5. And here's what's crazy. There are 400 companies who have an average valuation of 3 billion. And then there are already 70 companies in the public markets where they have $1 billion of next 12 months of revenue. And it just goes to show you, to your point, Friedberg, if these folks have to generate an 11% hurdle rate, their cost of capital is 11%. The companies on the left will have to go through a lot of very difficult cost cutting, potentially headcount reductions, repricing of the product, all kinds of things.
And so many of them have. Yeah.
No, none of them have.
Oh, of these? Many of these are on the layoff tracker. Yeah, on the left, right.
400. There's almost 500 companies here that have to do an enormous amount of work so that they have a chance to be on the right-hand side of this chart.
Yeah.
The point is that you didn't have to do this when rates were zero. There was just an abundance of free money and risk-seeking and duration that is now out of the market.
Chamath, I think there's also a story that of the 200 companies that are public software companies that you see on the right, some number of them will need to go private in order to do the restructuring that the market is demanding that they do in order to get rightly valued.
And to your point, it will happen at meaningfully lower valuations than where they probably went public or their last private round. Which
so
will
what
put
do you guys, as you guys look at these 200
pressure.
companies, as you guys look at these 200 companies on the right, how many of them do you think go private over the next 18 months to get restructured? What Elon is showing everyone is possible at Twitter.
18 months is hard to predict, but to your point, Friedberg, I think if you look at the number of them that are unprofitable, at least half of them will have difficulty. And so I think about 2/3 of these companies really have no line of sight to profitability in the next 2 to 3 years. And again, if you layer in this cost of capital argument, all of those companies, David, will have to raise money at very egregious terms in order to keep themselves going as a public business, in which case their alternative is to go private in a PE transaction. So it's probably at least half these businesses.